I'm Andy Panko, owner of 10N Financial. Welcome to Retirement Planning Demystified. If you have a regular brokerage account and sell something inside it for more than what you paid, the amount of that gain will be taxable. But did you know there's a way you can reduce your taxable gain? It's called tax loss harvesting, and I'm about to explain what it is. But before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. When you have a normal brokerage account, you trigger off a tax event anytime you sell something inside it. If you sell something for more than what you bought it for, you'll have a gain. Any gain you have will be taxable in the year of the sale. If you sold the position less than a year after buying it, that gain will be a short-term capital gain, and it will be taxable at whatever your ordinary income tax rate is. If you sold the position more than a year after buying it, that gain will instead be a long-term capital gain, and it will be taxed at rates that are lower than your ordinary income tax rate. Specifically, as of 2020, federal long-term capital gains rates are either 0, 15, or 20%, depending on how much other taxable income you have for the year. Whether your gain is a short-term or long-term capital gain, it will be taxable nonetheless. On the other hand, if you sell a position in your brokerage account at a price less than what you bought it for, that will be a capital loss. In figuring your final federal taxable income for the year, the IRS lets you use your capital losses to offset your capital gains. If the resulting figure is a net gain, then that amount will be taxable. But if the resulting figure is a net loss, that loss can actually reduce your other forms of income, like wages, pensions, or Social Security, by no more than $3,000. And any net loss you have above and beyond $3,000 for the year will be carried over and applied toward future years' capital gains or other income. Keep in mind this treatment of losses is only regarding federal taxes, not state taxes. Each state may have its own unique treatment of how it taxes your capital gains or losses. Tax loss harvesting is the act of consciously selling positions in your brokerage account at a loss to help offset gains in the account. And it's important to note that the idea of tax loss harvesting only applies to normal after-tax brokerage accounts. It does not apply to tax-deferred accounts like IRAs or 401ks, and similarly does not apply to Roth accounts. That's because there are no direct tax impacts of selling positions inside tax-deferred or Roth accounts. Selling positions are only taxable events when they're inside a normal brokerage account. Let's take a look at an example of tax loss harvesting in action. Let's assume you sold a position inside your brokerage account this year for a gain, and we'll assume the gain was $10,000. If you have no losses inside the account, all $10,000 of gain will be taxable this year. But let's assume you also sold another position this year, and that position was sold at a loss. Specifically, you sold it for $8,000 less than what you paid, which means you have an $8,000 loss. For tax purposes, you net these two together. In this example, you start with your $10,000 gain, and then you subtract from that your $8,000 loss. The result is you're left with only a $2,000 net gain. The other $8,000 of gain was basically erased by your loss. That's tax loss harvesting. Now, you're probably thinking, great, I have a smaller taxable gain, but that's because I lost $8,000 on a different investment. So did I really come out ahead? Well, that's a great question. And no, you typically shouldn't hope for losses in your investments because you invest to make money, not lose money. But let's face it, they can't all be winners. You're going to have losses here and there. Tax loss harvesting isn't hoping for losses or intentionally trying to generate losses. Instead, it's the act of controlling when you sell to realize and take advantage of unrealized losses you already coincidentally have. Let's go back to our example. Perhaps that $8,000 loss was something that has been a loser for years and doesn't show much promise going forward, but you've been holding off selling it for no particular reason. And then unrelated to that, another position you had did really well this year and you decided to sell it to lock in the profit, and that generated the $10,000 gain you'd otherwise have to pay tax on this year. Well, this could be a great opportunity to finally sell that loser or harvest its loss to offset the gain you now have. If it appears you're likely going to take a loss in that position anyway, you might as well get some tax benefit from it and use the loss to reduce the amount of tax you're going to have to pay on the position that did make money. That's the premise of tax loss harvesting. Tactically selling and realizing losses to offset gains you'll have in the same year. There's one other important thing you need to keep in mind when considering tax loss harvesting, and that's avoiding a wash sale. A wash sale is an IRS rule that says you're not allowed to deduct or offset your loss if you purchase the same or a substantially identical security within 30 days before or after the sale that created the loss. As an example, Assume a few years ago you bought 100 shares of stock ABC for a total of $1,000. And then today you sold all those shares for only $800. That would normally be a deductible $200 loss on this year's tax return. But then assume you go and buy 100 shares of ABC 10 days from now and pay $900 for it. Because you purchased ABC within 30 days of when you sold it for a loss, the deductibility of that $200 loss is now disallowed. Even though you don't get to realize that loss on your tax return this year, it thankfully doesn't disappear forever. Instead, you get to add the disallowed loss to the basis or cost of the new purchase. In this example, you purchased the new shares for $900. You would now add your disallowed loss of $200 to it, so you would be treated as if you bought those shares for $1,100. Whenever you eventually sell the shares, your gain or loss will be based off an initial purchase price of $1,100, not $900. There are a few more details to keep in mind around wash sales. For example, if you're married or control a company, neither your spouse nor that company are allowed to purchase the same or substantially identical securities within 30 days before or after your sale. In other words, it's not just your trading activity that will be subject to the wash sale rules, it's also the trading activity of your spouse and companies you control. Furthermore, it's not only individual stocks, bonds, or mutual funds that could trigger a wash sale, it's also instruments that give you the right to buy or otherwise give you exposure to those securities that can also cause issues. As an example, if you sold shares of ABC for a loss, buying a call option on ABC within 30 days before or after that sale will result in a wash sale. Wash sale rules can be complicated, so be sure to talk with your tax professional if you have any questions about this. Well, that's it for tax loss harvesting. I hope you found this video helpful. If you haven't already, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, be sure to join my free Facebook group, Taxes and Retirement, where you can get answers to all your retirement-related tax questions. Thanks for watching. I'll see you soon.